Thanks for clicking! The London and St. Thomas Association of Realtors, LSTAR, has released London's real estate data for the month of September, showing some signs of potential renewed activity.
It's begun!
Indeed, LSTAR President Kathy Ames, or Amos, I'm not sure, they don't answer emails, said that the Bank of Canada's third rate cut of the year may have been a factor in pushing up activity, one that the board hopes will continue into the fall. And that could in fact be the case. With the changing mortgage rules set to come into effect in just a few months, we could see buyers trying to get into the market on anticipation of those changes. The Free Press actually interviewed some realtors and mortgage brokers in the aftermath of the rule change announcement, who said that those changes could spur more buying activity. Though, as history has shown, if the industry is predicting something, then that's usually a pretty good sign that, well, they'll get it right one day.
Yeah, we will.
No, we won't.
With that said, as we'll see, the increase in activity was not enough to push prices up, with the benchmark, average, and median prices all falling in September. So what I want to do today is go over London's real estate data for the month of September, take a look at how these rule changes could affect affordability and buying power here in London, and then discuss some implications. As we'll see today, it's far too early to offer any type of educated guess as to where the London market is heading, as there are a few contraindicative signs emerging. We will obviously continue to track London's market on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this data. Onto the data. First up, the benchmark price. The benchmark price, if you'll remember, that's the price of a home that represents the most popular set of features. The benchmark price was down in September. The benchmark in August was sitting at $623,500, and that fell about $12,000 to $611,500 in September. So the benchmark is down about $12,000 since last month, but still up about $16,000 since this point in time last September. And the average price fell as well. The average price in August was $629,000, and that fell about $8,000 to $620,976. So, the average price down about $8,000 since last month, but still up about $1,000 since September of 23. And the median price fell as well. The median price, if you'll remember, that's where half as many homes that are sold over that price and half as many are sold under that price. The median price in August was $600,000, and that fell down to $585,000 in September. So, the median price down about $15,000 since last month, and down about $7,000 since this point in time last year. In London, homes continue to sell for under asking, as we can see when we look at the sales to list price ratio, which measures by how much over or under asking the home sells. So if a home is listed for $100,000 and sells for $95,000, the SLPR would be 95. London's SLPR in August was 98.1, and that fell marginally to 98 in September. So on average, homes are selling for 2% under their asking price.
You still owe me.
And finally, the months of inventory measurement, the MOI, which measures if no more homes came to the market, how long would it take for London to completely run out of homes for sale. And the MOI remained unchanged in September, sitting at 4.7 in August and 4.7 last month. So, we have a benchmark price down $12,000, we have an average price down $8,000, we have a median price down $15,000, we have homes selling for more under asking, with inventory remaining relatively unchanged.
It's begun!
With all of that said, what we really want to understand is how much demand is coming back to the market. Given how many times we were told over the past 6-8 months that the minute the Bank of Canada cut rates, demand was going to flood back into the real estate market. And we did actually see some movement in sales, with sales coming in at 400 for the month, still massively low for September, but higher than it's been in September for the past 2 years. And on that, we don't just want to look at the nominal amount of sales in September, but what we're really looking for is the rate of change. Did we see any major changes, any unexpected changes between August and September, given that the Bank of Canada has now cut rates by 75 basis points? So let's take a look how the sales numbers usually change between August and September. For the past 10 years, as we can see, sales usually drop between those 2 months. Kids going back to school, the Western Fair, etc., nobody really wants to buy a house. In fact, the only time during the past 10 years that we didn't see a drop in sales between August and September was first in 2020, and then again last month, when we actually saw a 4% increase in the number of sales in September from August. So yeah, we are seeing a little bit of abnormal sales activity happening in London. Not enough to move the needle, definitely not enough to push up prices, especially considering that London has the highest number of active listings that it's had in a September for the past 10 years. So definitely not enough to identify a trend, but still abnormal sales activity nonetheless. Definitely something to keep an eye on.
Nothing will ever be the same again!
And speaking of things to keep an eye on, the number of new listings coming to the market, which London saw the highest amount of new listings hitting the market in September for the past 10 years. Further, it also saw a larger amount of new listings coming to the market relative to August than it usually does as well, with a 16% increase in new listings relative to August compared to the 10.5% that we usually see over the past 10 years. So we did see an abnormal surge in the number of sales in the London market in September, but we also saw more new listings coming to the market than we would usually expect as well. So right now, it's a bit of a mixed bag. We have more sales than we would expect, we also have more listings than we would expect, and as such, the months of inventory measurement, the MOI, has remained unchanged as we discussed earlier. Meaning, with sales ticking up, but also being met with more new listings and a months of inventory measurement remaining unchanged, anyone that tells you that prices are surging up tomorrow is flat out lying. Meaning, buyers have a lot of choice and buyers have a lot of power, so once again, finance conditions, home inspections, etc. And, as always, because it's true and it's funny, if your realtor doesn't want to protect your financial interests, get a better realtor.
Sarcasm. Snark. Wise cracks.
But how long can this last? How long can inventory keep up with the increase in demand coming to the market, especially with the introduction of the 30-year insured amortization coming down the pike in a few months? Well, let's take a look at the current benchmark price of $611,500 with minimum down payment requirements and a 4.44 interest rate qualifying at 6.44. Borrowers would have to earn about $120,000, so long as they had zero debt, in order to buy that benchmark price home. However, now that borrowers can go 30 years, they would now have to earn about $110,000 to buy that same benchmark price home. Given that, according to Stats Canada, the median household income in London is $79,500, and of London's population, the majority are homeowners already and wouldn't qualify for that 30-year AM, with only about 5% of potential borrowers under 35 making enough to buy that home, I'm not sure that extra amortization indicates that much of a game change on the ground that so many are predicting. With that said, obviously, as we discussed before, that 30-year amortization is going to expand buying power for those who were already able to buy. So those who were already able to buy that benchmark price home, those making that $120,000, they'll now be able to buy a home worth about $650,000, $660,000. Therefore, everybody will be able to bid up prices a little bit more. Though, as we saw, at least in that middle end, in really anything but the lower end, I'm not sure the extent to which these new rules will facilitate the entry of new participants into the market.
You're welcome.
Regardless, as we saw today, we are seeing some early signs of new activity coming into the London market, though there's a plethora of inventory available for those new entrants trying to get into the market before the spring of 2025. Rates are also coming down, which is obviously going to provide for more buying power, so we do have the extended amortizations along with lower rates, allowing for new participants entering into the market. More buying power for those participants. But, as we discussed before, that also comes amid a continually weakening economy. How those two, the weakening economy with lower interest rates and looser mortgage rules, intersect remains to be seen, but we will obviously continue to track their effects on the London market on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.